This video shares my early trading journey, the mistakes, the lessons, and what I wish I knew before trading CFDs. I blew up my first account within 3 months of discovering CFDs. Not because I didn't read the risk warning. I did, word for word, and then I opened a trade anyway. Over-leveraged, no real stop, convinced I'd spotted something the market hadn't. The danger with CFDs isn't ignorance. Most people know it's risky. They just don't feel it yet. So let me try to bridge that gap before the market does it for you. A CFD, contract for difference, means you're not buying the actual asset. No shares sitting in a portfolio, no gold in a vault. You're agreeing with your broker on a price, and when you close the trade, whoever was wrong pays the difference to whoever was right. Price goes your way, you collect. Price goes against you, you pay. That's the whole thing. CFDs are legal for retail traders in the UK, Europe, Australia, Singapore, South Africa. In the US, they're banned at the retail level. So if you're watching from the States and someone's pitching you CFDs, they're either using an offshore broker or the story has a hole in it somewhere. Most people trading CFDs are day traders. Makes sense. Tight spreads, fast execution, in and out within the session. Scalping indices, FX, gold, swing trading is possible, but the costs compound quickly. Overnight financing charges, weekend gaps. When you're leveraged, those aren't small numbers anymore. Going long, you buy, you want price up, you set a stop below something meaningful and wait. Going short, you sell first, hoping price falls, then buy back lower. No borrowing needed with CFDs. The structure handles it, but if price moves against a short, you're covering every pip of that move. Margin is where people really come unstuck. You don't fund the full position. You put down a fraction, say 3%, 5%, and the broker covers the rest. £1,000 account can suddenly be controlling 30,000 pounds worth of market exposure. That feels like a superpower until price moves 0.5% in the wrong direction and you've wiped out a chunk of your account. When losses eat into your margin far enough, you get a margin call. These days, it's not a phone call from a broker in a suit. It's a notification on the platform, add funds, or the broker starts closing your positions. It happens faster than people expect, especially through news. Negative balance protection means you usually can't lose more than your deposit with regulated brokers. But I'll tell you from experience, watching an account hit zero still feels exactly as bad as you'd imagine. A few things I wish I'd taken seriously earlier. Keep leverage low on purpose. Professional traders often run 3 to 1 or less, not because they can't access more, but because they've done the math on what drawdown does to an account at higher multiples. Risk 0.5% to 1% per trade maximum. Set stops at levels that actually matter on the chart, not wherever your pain threshold is. Avoid trading through major news events until you understand how fast prices can move. Watch for overnight gaps if you're holding positions past the close, and stick to regulated brokers. FCA, ESMA, ASIC. The oversight matters, not just for protection, for the transparency it forces on things like execution and pricing. CFDs are a legitimate product. Used carefully by someone who understands the mechanics, they work fine. The problem is most people find them at exactly the wrong moment, when they're excited, undercapitalized, and looking for something that will finally make trading click. I was that person, and the market was a very efficient teacher. If you're trading CFDs right now, go slowly. The edge doesn't come from bigger positions. It comes from surviving long enough to actually develop one.